Hello, everyone, and welcome to another episode of the Rodcast. We are back with our quarterly investment mastermind, and I am joined by our regular mastermind guest, Manish Kataria from Invest Like a Pro, and Adam Lawrence. Um, gents, look, there's been an awful lot going on in the markets. We've just had a budget here in the UK. I think we probably need a bit of a rundown as to one, what's going on in the financial markets globally, really, and two, what is going on in the UK. So, who wants to start that one?
You want me to do the budget and manage to do the global because I think that probably makes the most sense in terms of what we spend our time focusing on, probably.
Sounds like a good
Um,
idea.
okay, so we had a budget that was fairly obvious for those who were paying close attention, was not going to be anywhere near as bad as most people were speculating. It ended up basically being a pretty classic Labour tax and spend kind of budget. But nobody wanted to own that or admit to it or anything like that for whatever political reason. It's turned into, it seems today that Rachel Reeves has also been outed for lying about her chess prowess as a youngster. So she obviously has an element of sugar that she likes to put on her CV and all the rest of it. But it's a shame she didn't just want to own it because, with that silly manifesto commitment from 18 months back to never raised VAT and never raise income tax and all the taxes that make a little bit of sense that can actually raise some significant money. We've just got this sort of death by a thousand cuts and electric vehicles are getting penalised and this and that. And, those of us who are lucky enough to live in a house worth over £2 million, maybe I won't mention that. That subject might be a bit too close to home, if you'll pardon the pun. But yeah, there's been a variety. The smorgasbord, which I thought smorgasbord was like a tasty bunch of morsels that was, really something quite nice. Whereas really we had a kind of mouldy Premier Inn cast off buffet that had been made the day before or something like that. But we're just going to get on with it. The 2% will be what upsets most of us and our audience the most, I guess, on dividends. I thought they were trying to encourage investment in shares myself, but with that sort of segue, I'll probably hand over to Manish to talk about the broader markets in general, I think, Rod.
Great, Manish. Over to you.
Yeah, yeah, and I agree. Just broadly on the budget, from an investor's point of view, there wasn't really much in it, really. We had all these sort of fears about what they'll do to pensions and the lifetime allowance and contributions. The only thing that was mildly disappointing was the kind of the salary sacrifice,
I was
and
going to actually make that point, Manish. I thought
yeah.
that pension sacrifice was, or sorry, salary sacrifice for the pension. I just thought that was mind-bogglingly crazy when you put it into context with all the fiscal drag that's going on with the kind of tax element of earning over 100 grand between 100 and 125 grand, that tax trap and things like that. I thought that was bananas,
Yeah,
but yeah.
yeah, didn't make much sense. But for those of us who have limited companies, we are not affected by it because we can put money from our limited companies and do employer contributions into our pension. So there's always a way around all of these things. Even the cash ISA limit, which was reduced, what we can do there is we can invest in money market funds through stocks and shares ISAs, and so we can still invest 20K into cash investments. So there's, a lot of these times there are always mitigations around some of this stuff. But on the markets, yeah, look, we're having another good year in financial assets, including stocks. Global equities are up anywhere between 15 to 20%, depending on the region. Gold is up, gold is on fire, silver's on fire, up more than 50% year to date. Crypto is down. Apart from that, financial assets are having a good year, and that's been driven by a couple of things. So, we talk about earnings growth a lot on here, right? So, earnings growth is having another double-digit up year. AI's playing a large part in that, but AI spending is huge. We know that from the tech companies. But AI is starting to have an impact on cost reductions and also new revenue opportunities for non-tech companies. So that's a positive. We can only imagine that to sort of keep going in that direction. The economy is not powering ahead, global economies are not powering ahead, but they're not weak as well. So we've almost got that sort of Goldilocks scenario, which will enable rate cuts to come. We're expecting the rate cuts in the US and the UK shortly, soon. And yeah, I mean, the key question everybody's asking is, are we in an AI bubble? So, that's always the sort of unknown, but the fundamentals are pretty positive as far as stocks are concerned.
Do you think that rate cut is still coming in the US, Manish? Because obviously there's been a big swing in the market's impression of how likely or not that cut is, specifically this month. I mean,
Yeah, I think, well, I was looking at it the other day actually, and there is still a widespread market expectation of a quarter uh, percent cut. So that's being priced in by the markets and is expected. So, given that it's priced in, if it doesn't happen, we're probably going to get some disappointment. I mean, it's been signaled. So when things have been signaled, it's rare that it doesn't happen. But look, yeah, in the last few days, we have had some noise against that, I guess. Yeah.
God, there is a lot going on, isn't there? And I mean, with this kind of AI bubble and things like, really, I guess the way to look at it is, or one of the ways that I kind of think is good to look at it is just to understand kind of some of these sort of price to earnings and book values and forward earnings and how much they need to continuously grow year on year. Because I can't remember, I think it was Nvidia that I can't remember the actual figures of what their forward earnings looked like, but it was something like they needed continuous growth of what they're doing for something like crazy, like 50 years, to justify the kind of price. And I do think there's certain companies, whether that means the whole stock market is in that place or it's just a few of the big sort of Mag 7 ones that are propping up that view of the whole S&P, then that's quite different. But I do think some of these are quite overdone and overcooked, especially when you look at actually where are the earnings coming from. I know we're gonna get stuck into one of those big companies in a bit, but yeah, I think it's really interesting.
yeah, I think you're right, Rod. And I think you can probably separate the Mag 7, or at least probably five of the Mag 7, away from the rest of the pack, because I think the larger companies are doing very well, and it makes sense that they're doing very well out of AI because there's been, $1 trillion+ invested, and they're getting to get savings, which is ultimately what shareholders love nothing more than cost cutting. They're getting cost cutting at extremely good value for the amount of money that's been spent on the research and development side of things. So it's hard to quantify just how much. And like you say, reminiscent of 1999, I think it was Cisco that they needed to grow at a rate that would have seen them larger than the whole of the US economy by 2075 to justify their forward multipliers and their PE ratios. And of course, that's physically impossible. So it couldn't happen. And that was not long before the old pop. But it's always different, isn't it? And this time is different because there are real earnings there. But in terms of the multiples that things are trading at, some of them do look awfully hopeful. And then there's this circular thing going on with, well, we're going to buy $100 billion of this with the 100 billion that these guys are giving us for doing this. And it's kind of like, that sounds like the same money. And also you haven't got it at the moment. And you're going to really need to hit some targets in order to have it?
Hmm.
Maybe Elon Musk will just fund everything with his $1 trillion bonus. Um,
Yeah.
I think, like, yeah, I think there's. It's really interesting, isn't it? Because especially with the American companies that are giving off earnings and they are kind of doing well, there is an element of like the whole kind of look indexing and passive money just flowing into that, which kind of keeps this. I don't know what you want to call it. Not Ponzi scheme, but like the money keeps
Circus. Let's
flowing.
stick with circus. Keeps the roundabout going round, right?
Okay, yeah. I mean, there is an element of truth to that. That actually, every time there is a dip, like that money comes in to cover it up, and we've seen that. I don't know for a few years now. And so I kind of think, well, look, the market is fine. It's just maybe some of these companies that are so big that maybe their pricing might not be fine, but because they're so big, they are the market. And that's kind of that's what I'm a bit kind of
Well, if you look at the size of some of these compared to when we first heard the phrase "too big to fail"
yeah,
nearly 20 years ago now, and these it absolutely eclipse some of those banks and the likes that were mentioned first time round.
yeah, yeah.
At the same time, if you look at Nvidia, it was down in November, it was down more than 10%, right?
Mhm.
And that's the bellwether of AI and bellwether of the stock market. It's the largest company in the US. So it was down 10 odd percent, but the US market was still up on the month, right?
Yeah,
So
yeah.
that was really encouraging for me to kind of see that because, it's not leading the entire market down, and this month was a case in point. November was a case in point. So yeah, look, I kind of hold on to the fact that, there are some big companies who, big tech companies who are driving a lot of this. But at the end of the day, I think AI is going to benefit far more the non-tech companies, the banks and the oil companies and the pharmaceuticals and the healthcare and all of these regular sort of sectors outside of tech. And that for me is the big sort of future growth driver.
Like
I agree.
I think we talked about this on a previous episode, but I totally agree because I think those low margin companies, let's say you've got a company that makes a margin of 1%. Okay. So really low margin company. If now you can reduce that company's costs by a fraction, and that can increase margin by to 2%. So by
Mhm.
100%, your margin increases. That's the sort of thing AI can do for a lot of these companies. It can reduce costs to increase margin. And suddenly you then look at what those forward earnings look like. And I just think that's really, really powerful.
That's the thing. Yeah, and
Yeah,
that's
I think you
that's
made that point the other way round before, Rod, but it's extremely
Yeah.
valid when you look at it like that. Absolutely.
mm, yeah, that's classic operational leverage.
Yeah.
And you have that, and these same companies typically have low price earnings ratios as well. So you get the twin impact of profits growth and multiple expansion. So yeah, and this is all outside of tech.
Should
Well,
we
and
have
you've seen 6 years, haven't you, of margins starting to get squeezed in
Mm.
industries like that because of staff costs and because of this and because of that. Arguably, we're over the hill there, especially in the UK, because unemployment's been going up like a rocket. So there's a really interesting case there for some bargains. Yeah.
Well, should we quickly talk about the UK then, based on because I've got some concerns about things like the lower end of the value chain, minimum wage going up, the motivation for investing in employees, for example. Some of those kind of, if I don't know, I had a business that was retail and we had 10,000 staff who were all kind of minimum wage or thereabouts, I'd be really bloody worried about that because actually I need to know my operational cost, my wage bill is gone through the roof with minimum wage and national insurance. So then actually I've got to get, I don't know, AI or something to come in and help me out here to take a real big kind of portion of that operational cost. Now, I do think that's fairly specific to the UK, but it is tricky. I mean, with for investment there. So I do think, whilst I think yes, there definitely are bargains to be had. I think you've got to price in that risk at the moment, which is a little bit tricky. And we've said before that actually you want unemployment. Well, no one wants unemployment to go up, but you kind of to have a productive market and a productive economy, you don't want unemployment to be really, really low, sort of under 4%, because then the only way you can get in, kind of, you can buy in skill is by paying it more for it. So in order to get productivity, it's quite good as a whole. Obviously, it's not very good for those people that are unemployed, but it's good for there to be some level of unemployment, so that actually people are there's a greater demand for some of those skilled jobs and things like that. And
So can I just say something about that, Rod? Because the logic is sound. Ultimately in these situations, companies trim off their least productive workers. So
I
productivity
feel a
goes.
butt coming on.
Well, there is a but coming on because when you look at the data in terms of where growth actually comes from, where growth in productivity comes from, it comes in times of expansion, rapid expansion usually.
Does it come
So
from the
it's this.
States?
This is not usually a precursor to rapid expansion, this sort
Yeah.
of thing. So, what you do get though is you do get some short term gains in terms of employees suddenly realize they're not, because in the last few years, there'd be many an employee who's been walking around feeling absolutely bulletproof in a job. There's very few of those at the moment. And having recently recruited for a post, I can tell you of the excellent candidates that applied, that frankly were at a higher level than candidates than I've tried to recruit for posts over the last several years because just because of the structure of the market, ultimately, 75% of the really good ones have just been made redundant in the past 6 months. So they wouldn't have been in the market before all this started happening. So there is definitely pressure on the employee, which also can lead to short-term productivity gains, but it's not a long-term fix. And our problem in the UK is we need a long-term fix.
Yeah, and that's probably about the size of the state and all that kind of stuff versus the private market because growth comes from the private sector.
The problem with socialism is you run out of everybody else's money in the end, right? We know that one. So there is, people are saying that not necessarily with their tongues in their cheek right now.
Yeah. Okay, so shall we get on to our picks? If you're joining us for the first time on one of these mastermind investment episodes, we each pick a product that anyone at home can go and buy through an ISA or a pension wrapper or stocks and shares. It's a financial instrument we're going to purchase. And this is not investment advice, it's just a bit of fun, but we talk about why we're making that pick. We put it out to the others to critique it, and then we normally tell everyone how great our picks that have done well in the past. We keep very quiet about the picks that haven't done so well in the past. So I'm sure we'll go through those. So any volunteers for going first? I'm
I
happy.
think I went first.
I
You
I
go first because I don't think you've been first for a while.
I think I'll go
You go
first.
first.
So a few months ago, or 2 quarters ago, I think I picked URNG, which is an ETF for uranium energy. And I think the last episode, I was very quick to tell everyone how brilliantly it had done. And it had gone up, I think, about 150%. So it had done very, very well. It's come down a bit now. I think it's still up about 110% from where I was. And I am going to pick, well, I'm not going to pick it again, but I'm going to pick another uranium nuclear energy ETF. I'm going to do the Wisdom Tree uranium and nuclear energy. And I'm doing that because it's got a cheaper expense rate. So the URNG one is a little bit pricier at 0.65%, and the Wisdom Tree one is 0.45%. So that's why I'm changing up where I'm getting it from. But really, the fundamentals for me are the same. And those are that we need energy globally, um, especially with this AI boom. Even if all AI is overpriced, it's not going away. It's part of everyday life now. A bit like kind of the dot-com boom. We're not going to stop using the internet, even if prices are seen to be far too high. And we need energy for it. We need energy for these data centers. We need energy all over the place. And we're still not util. There's still kind of a big, even though it's a bit less so than it was a couple of years ago, but there is still a lot of stigma around kind of fossil fuels and what have you. And it does seem that nuclear really, unless we're harnessing energy from the sun in a big way, which there is talk of actually, this is the only realistic thing I think that will do it. And it will take decades to do that. But I do think the long-term prospects are very, very strong for it. The negatives are that everyone is pricing nuclear energy um, proportional to the AI boom. and they're thinking, right, well, if AI comes down, this will come down. And I do think that if investors, if there is a pop in this AI bubble, it will affect the pricing of uranium and nuclear ETFs in the short term. Because they'll go, AI, let's run out of AI, let's sell everything in AI, and that's to do with that, and they'll put that in the same bucket. But then I think they'll quickly realize, hold on, no, we still are using AI, it's still happening, and therefore we still need to invest in that. So I do think that's maybe a downside. Normally, I'd look at something that's gone up by 110% in 6 months and run for the hills because I would just think, God, no, that's it's had its kind of you've had your fill out of it and it's not going. But I do just see the fundamentals as still being massively in need in terms of energy sources for what we all use. And at the moment, like we're using AI day to day, and that is not going to stop. Or I can't see any reason why it's going to stop other than there's not enough energy. So,
I, I actually
yeah,
think, Rod, I'm actually more positive than you are on your sort of bear case. And the point's well made about AI. But when you think about historically, if you saw a big multinational expand into a developing market, right, like a Unilever or a Procter and Gamble or someone like that, they expect to lose money for years and years and years while they grab the land, right? So even if the AI bubble does pop, the big companies that are still making money from all their other stuff, right, I think are still going to be plowing an awful lot of money. I think they might redouble their efforts, some of it, because suddenly they won't need to pay $100 million a year to procure the best AI engineer or whatever, whatever. And they'll just go for even more hell for leather and they'll be expecting to invest, to speculate, to accumulate. So I think that plus the old Rolls Royce slash investment in North Wales. And if we can do it in 3 to 4 years, which is obviously what we've been quoted, whether that's what will happen, we don't know. But if we can, other people will be doing it in 5 minutes. And you've got the private sector with a lot of skin in the game at the moment who are actually going to put the best people and the most money into, putting some real effort into being entrepreneurial about this stuff.
I guess where my point on that is maybe again, I'm trying to talk down my own pick, but like if um I would look at where's the money being generated from these AI companies. So um like Nvidia is an obvious one because it's just selling the chips. But when you talk about Google and Microsoft and what have you, is where is the revenue coming to pay for these capital expenses? Where is that coming? Is it still going to be some form of search? Is it going to be advertising? What's it going to be? And so I'm not really completely clued up on where that's
Well,
coming.
we're not paying when you go on ChatGPT and all that, you can have a free
Exactly.
account, but
Yeah.
where their revenue drivers are from the corporate sector at the moment, right? So these are the people who are paying for all this stuff. And in time, we will pay for all that. Of course, we're
Yeah.
going to pay longer term, but the revenues, I mean, these guys, I mean, they're sophisticated companies and they're seeing, and it's not just AI. Remember, we've got the next level, which is quantum computing and all that. So I'm not worried about the demand side. I think that's gonna, we're only just starting. The only question I would ask about this is in the supply side, and only because I don't know what the supply outlook looks like on uranium. So, is there anyone else who's producing uranium? Because these companies and this ETF will be sensitive to uranium prices,
Yeah.
right? Essentially, and uranium prices are determined by not just demand, which I think is here, but it's more supply as well. And I don't know what the balance looks like.
Well,
I think the answer to some of that is uranium is much more of a known quantity than something like lithium that's become much more useful, much more recently. So you still see the odd surprise lithium discovery in X or Y, giving people a strategic advantage. Correct me if I'm wrong, Rod, but you don't see a lot of uranium discoveries. It's much more of a known quantity.
I'll be honest, I don't know the answer to that. I'd have to
We'll
go.
just go with what I said. It sounded right, so
Yeah,
it's
it
all good.
sounds sensible, so let's go with that. I mean, I would say that one of the downsides of this will be liquidity. So what you'll find is these ETFs will not be particularly liquid. So if you're holding it for the long term, great. If you want to get out when you've made some gains, great. I mean, like I said, it's it's pretty volatile. It went up to 150% in that sort of 3 4 month period. In the next 3 months, it dropped by sort of another double figures, and things like that. So it is quite volatile. So that again will be your probably a negative anyway. Um, and certainly, I think this Wisdom Tree ETF is slightly less liquid than the URNG one, again, which is probably justifies the expense ratio and things like that. So yeah, I think I'm just looking at for the downsides, and I think as long as those they are the downsides, I'm pretty comfortable with them, really. I guess the only thing maybe that could come and change that is if suddenly loads of oil comes on the market and coal comes on the market really cheap in the shorter term, then things kind of might be pushed back a little bit. Um, I don't know enough about the oil markets. I know kind of Trump wants to keep oil prices down, things like that. So maybe that could have an effect in the shorter term. But again,
I'm not sure if oil doesn't really create power, so it's more,
yeah,
yeah, it's more coal
yeah,
and solar and all of these other things that yeah, that's going to be the main sort of competitor. But I think uranium's here to stay, right?
yeah.
It's a clean energy, and then you get those sort of smaller sort of mini generators as well, which a lot of these AI companies are using. So,
Well,
you know,
the obvious other downside is if we have another kind of Chernobyl or something like that that was to come up, that would obviously have a massive effect on pricing and terrify everyone. But
Well, you wonder if, like Fukushima, though, did an awful lot for understanding and needing to, because obviously climate change, bigger monsoons. We've seen some of the biggest since the last time we recorded one of these, some of the biggest natural disasters on record, which is the future that we have ahead of us. There's no two ways about it. But the eyes are much more on this stuff, I think, since Fukushima than they were beforehand. Doesn't mean it can't happen, of course. And
yeah.
whether these mini reactors, how sensitive are they to a seismic event if there's going to be all over the US, for example? I don't know. So of course, a little scare is blown up in a big way when it's nuclear. That much we know for sure.
And I guess the other issue is probably just time frames and how long it bloody takes. Like you said, I would, yeah, I just can't see anything happening in 3 or 4 years being built when you look at kind of what happened with HS2 and things like that. But like, I think it's more like decades to build things that are where you're going to get something back from it. So that is a bit of a concern because when things are so far out like that, you just investors do get a little bit wary of going, oh, do I want to lump a load of capital into this?
No, but these things are modular, right? So there should be much more of a known quantity. Should should.
Yeah, you'd hope so. But yeah. So anyway, I've focused really on the downsides, but actually, I'm very kind of bullish on this long term, and yeah,
I'm fully in defense of people who pick things that have gone up a lot in the last 12 months or so, in a non-conflict of interest at all, given that I've picked something that's up about 55% this year. Do you want me to go next, Rod? Because it follows on to some of that quite nicely, I think.
yeah. Let's go with you there, Con.
Okay, so I've picked Google, not just because I'm utterly in love with the Gemini product at the moment, but it has gone forward leaps and bounds and is currently a million miles ahead, I think, of where OpenAI are. And I think Google have got OpenAI in real trouble, to be honest with you, for what they've done over the past few weeks. But it's not just the product front-facing side that I see and love. It's also the fact that ultimately they've got control of their own processing unit, so they're not held to ransom. They're the cheapest of the Mag 7 by forward PE ratio, and that doesn't feel right to me at the moment. I don't know how that's possible, but they're also making a ton of money from cloud at huge acceleration rates. So they're really taking a bite out of the market and causing Amazon some problems. And we know how profitable cloud has been for and AWS is for Amazon. And Google, I think, are a seriously dangerous company when it comes to grabbing market share and things like that. And Manish already mentioned the quantum, which was really going to be the third point of my triangle. Like Rod, accept that it's gone up a lot already, but I still think, even though we're buying in a potentially bubbly AI market, there's a lot more to Google than AI. and I think they've got a really strong future runway. And I fully expect them to be at some point in the next couple of years the largest company in the world by market cap. I really, really do. A lot of faith in their diversity of revenue stream and their logic and their business strategy. And I just think they're a cut above and there's more to come. And we might see another 40, 50% go on this stock in the next 12 months.
I love Google as a company. I use all their products, and I'm technologically challenged. So like if I'm using it, I just think that's quite a good sign. Um, One of the issues I guess I would have is you benchmarking it against other Mag 7s. And I don't know what's the price to earnings now. It's about 30 or something like that.
31, I think it
Yeah.
is. Yeah, but the forward PE is about 24.
Right, okay. And I guess like where the revenues are coming from, because obviously search is I think their biggest revenue generator or biggest profit kind of case.
But remember how much search has grown since LLMs have been. I mean, I know they're saying in 12 months' time we'll all be shopping through GPT slash Gemini slash whatever, and I see that. But when I look at the sort of GPT's got 3 times the market share of Gemini at the moment on LLMs, I can honestly see that being flipped on its head, or at least becoming back to parity relatively quickly. And I think the micro commissions model throughout which Gemini becomes and just does bloody everything for you, basically, will bring money from everyone, not just like you guys were saying, the big revenue from the big corporates. So we're going to become more and more dependent on AI because it's going to reduce headcount. HP have said they're going to get rid of 6,000 jobs relatively recently, haven't they? And that's knowledge work stuff. That's not robotic slash automation stuff. So yeah, I mean, look, I take your point, and there's obviously risk involved, but I think there's the monetization of this stuff. Where it's a bit like, isn't it? If you invested in Facebook at the IPO, was that a good idea? Well,
Depends when you're selling.
but it was an unproven business model at the time, wasn't it? Now, there are a lot of people who just invested in it because they love Facebook, but there was also people thinking, well, look, if you've got the attention of all these billions of people, you are going to be able to sell stuff to them. And ultimately, that's what's happened over the past 15 years. There's other stuff that's gone on as well, and Meta have done other things, obviously, but that's what you've got. And if you've got, I haven't seen anything. This is genuinely disruptive slash industrial revolution territory in my opinion. People are using it to talk to people for therapy, for girlfriends, for everything, all the way down to telling them which stocks to pick for the mastermind. I didn't really do that, by the way. I did pick this one all on my own. But it's utterly limitless, and it's only limited to your own capability as a human being, which I find quite humbling. But I think the way they've been so commercially clever over the years, monetizing what they've done. There is I think just to try and do a little bit of a Rod straw man my own side of the argument, there is the antitrust stuff
I was
that
going to
kind of
say,
hangs over Alphabet, and you can't ignore it. You are ultimately betting on what the outcome will be of some of that. That's part of this pick.
I
So
think a lot of that has gone now, Adam, because they came in, they were investigating them, and then they came in and said, okay, well, AI has already disrupted the search, monopoly position, so we don't need to take any action because AI has already done it for us. So I think they're relatively safe from an antitrust point of view.
oh well, that's excellent. In that case, double the bet. In that case, gentlemen.
The other positive here, Adam, you'll know this, is that Google is starting to make more and more of its own AI chips, right?
Yes.
So it's going to become less and less reliant on NVIDIA, and in the future, it might even become a major chip manufacturer in itself, and that could be a revenue driver.
I'm
So
sure they will. It's he who sells the shovels in the gold rush, my friend, etc., etc.
yeah.
Absolutely.
Yeah, I like it as well. I'm like you, Rod. Look, I'm a big Google fan. I have a Google phone. I use Google software and the full works. So yeah, I like it, and I'm obviously biased from that point of view. I think it's had a really good run this year. I think timing wise, it's always hard to tell on timing, but it's up what 60 to 65% this year. So it a lot is priced in. I think a lot more will come. I just don't know when is the right time to be buying in. I think you want to pound cost average this in and get this because I think this will, I completely agree, Adam. This is going to overtake Nvidia, I think, at some stage in terms of market cap and the size. So it's really, really hard to pick holes in this one. Honestly,
Yeah, but pound
I
cost
like it.
average is a really good point, though. Really good point. Yeah, yeah.
I would like to just for the record state that I did pick Google when we did one of these episodes. I think just around COVID time or just after COVID. And
Nostradamus strikes again.
and
Yes,
it's
indeed.
done
Indeed, he
very,
does.
very well.
Who needs Chat GPT when you got Rod?
I just won't tell you about some of the ones that haven't gone so well. But yeah, no, I think it's great. I think what when you're looking at say who's the competitor and where might that competition come from? Is it going to be Microsoft? Is it Amazon? So Amazon obviously on the cloud services. Not sure about search that they've really got much competition at the moment. I mean, on the chips, it's Nvidia. They seem to be they seem to be in a few different markets, and so when you are looking at competition, I think, although I said you're comparing forward PE to the Mag 7, like almost you're comparing, okay, what is that forward PE to, say, Nvidia on the chips, to Amazon on the cloud, to all these kind of things? Because then I think that kind of almost gives you a better idea of how good value it is or not.
Yeah, that sort of detailed level analysis would be great. Often people do things like that with Berkshire Hathaway, don't they, for example, and break it down to the sum of the parts. And that is a very, very robust way of looking at it. I haven't done that, but you're right in terms of Amazon on that side of things. Quantum computing, who's their biggest? I don't know. Where are Dell with? Dell is still a gigantic company. I have no idea what they're doing on an R&D front. What are Meta AI doing? I can't say I've used it much, haven't really seen, but you would be foolish to count Meta out of a race in anything realistically, and they've got so many users and so much data on those people. There's definitely competition from all sides, but there's that diversity of revenue stream that kind
Yeah.
of, balances that out, isn't there?
It's almost like a tech conglomerate, isn't it? Because it's got
Yeah, yeah.
search, it's got YouTube, it's got AI, it's got the full works. But I think, Rod, you raise a good point, which is if we're looking at Google as an AI play, if AI is going to be a big driver for it, we have to remember the AI space is very fluid, right? It's always changing. There's always new things coming around. So there's always going to be a new kid on the block threatening any AI player. So that in itself is an opportunity for Google, but it's also a longer term threat. And what's the new French AI chat box which is coming through? It's had rave reviews. There's always a new one, and we had DeepSeek, from China earlier this
Yeah.
year. So there's always going to be a threat, and AI is going to be. The thing about AI, it's really hard to pick individual stocks. You want to just, pick the whole sector or pick the whole index because that's going to be the
Yeah.
long-term winner.
My other consideration was whether it was an AI ETF,
Mm,
but I thought, do you know what? I'm gonna go with it because I thought we'd have a good discussion on the back of it.
mm.
But your French competitors are a bit like you. They probably face the same fate as a DeepMind or whatever. They get to a very, very nice valuation and then realize they've got to sell to someone American. And Google are probably at the front of the queue to be big beneficiaries from all of that. The only thing they can't do is social media. They've tried so many times and failed so many times, right? Everything else they have really got at least a really workable iron in the fire. And the sort of value chain control, like you said, these TPUs that they're producing, it just seems very smart. They seem to me a bit like I visualize a castle with a moat around it, realistically, and that's what they're building. And it's called Alphabet for a reason, right? 26 brilliant options, I think, is where their ultimate commercial strategy is one way or another.
Isn't YouTube their social media, really? I guess.
I mean, it does count as social media, really, doesn't it? And again, it's had huge, huge growth.
Yeah.
YouTube still, even though it's quite mature, but there's still an awful lot of untapped demographic that doesn't really use YouTube. So there's still room there, and there's still enough people, young people in the world before the whole birth rate collapse thing really starts to play out. They've probably got 10 or 15 years of good growth in YouTube, new accounts, and all the rest of it coming through the pipeline.
It's I think it was very interesting that you likened it to Berkshire Hathaway and like Manish said like a tech conglomerate because I do see that it's now starting to really become like all these different revenue streams and high profit centers and things like that, which yeah, look, I like I think we all love Google here. It's just whether the price is right, and at the moment it doesn't seem bad, does it? So yeah, I guess if the AI bubble does pop and suddenly investors go, do you know what? These forward earnings are crazy. I would just think, well, okay, if that Nvidia 50 like PE forward PE comes down by I don't know 20%, what happens to Google? Does that come down by 20% or do investors go, actually, do you know what? We're still kind of where we think it needs to be.
Well, it would kind of seem not, wouldn't it? Because of what Manish said happened in November, and there was this whole, Jensen is pretty famous for his earnings calls and how bullish he is, and then the actual report says something a little bit different sometimes, like, oh yeah, that 100 billion deal we said we were doing, we're not really doing it anymore, but kind of just put that in Appendix 3 or whatever and see what happens, and the share price just goes like that in a day, like madly.
Has he been
So
talking to
there's
Rachel Reeves?
Very good. I was quite good at chess, but not as good as Rachel. Not as good.
She's played once at school.
If you wanted to be a hedge fund, and the way to trade this is to go long Google and short Nvidia. So, you've got
Yeah,
neutral market exposure. You're
yeah.
playing the Google market share theme over Nvidia. So that's, you can do that, answering Rod's question there.
I like that. I like that.
Super. Great. Okay. Manish, I think you're up.
Yeah, so I've gone with Japan as a market. A Japan tracker fund is what I already own actually. So we've been talking about Japan and Asia in an attempt to get away from the US, to get away from the overexposure to the US. So Japan's had a good year. It's up more than 20% this year. So it's having a good year. But it's underperformed the US and Europe over the last, 3, 5 years. There's a lot of good stuff going on in Japan. There's a new prime minister. She's their first female prime minister. She's very reform-minded. She's the protege of a former prime minister, Abe, who was prime minister before the last one, and sadly he got assassinated last year. So she wants to carry on his legacy. She's very pro-reformist. And Japan needs reforms, right? Japan is, it's structurally, it's got an aging population. It is, the companies, they're kind of like dinosaur companies. They're run for employees,
Yeah.
not shareholders. So I used to work out in Japan a few years ago, and I could just see it, and it's chalk and cheese comparing Japanese companies to US or European companies, and they're just so behind the curve, behind the times. There's something like 10,000 manufacturers of nails in Japan. And, just crazy stats. You think, well, how can this still keep happening? And so, the corporate, so Japanese corporate world is prime for restructuring. And this has been talked about for a while, but a lot of people are thinking now this is the time because we've got AI. And if Japan doesn't restructure itself, AI will. So a lot of that is being reflected by a bit of positive sentiment in Japan. So I own it. What else? It's got cheaper valuations versus the US, 16, 17 times earnings, which is pretty decent. It's also, we're talking about AI. It's also got a lot of AI and tech companies which are doing really well, powering the stock market. So yeah, it's got restructuring potential. It's got exposure to AI. It's got low valuations. It's had a good run this year, so that's the sort of the thing to bear in mind. So that's my pick in Japan. There's a lot of good stuff going on, I think there.
What about the currency? Because obviously, if you're buying in that, you're fairly
Mm,
dependent on the yen. Um,
mm.
what can How is the yen performing for a start? And what do you and what are you kind of do you have concerns about? that in the future? Because obviously that's a risk if it's unhedged.
It is a risk, but remember, the Japanese market is very sensitive to kind of the yen in a positive way because you get a lot of exporters in the Nikkei. So when the yen goes down, the exporters
Yeah.
actually like that because their terms of trade, their export prices are more attractive. So it actually, if you see what happens, the Japanese market reacts positively when the yen goes down. So you lose on the currency, but you gain on the equity. But yeah,
Well,
currency has gone down this year. You're right.
but that would obviously be better. So what I'm saying is the gain that it's had this year down to currency, and what happens if the currency
Mhm.
value goes up during kind of some sort of restructuring that like you're talking
Yeah.
about? Because
Yeah, it's
then
so
investors
this
go, do you know what, bonds are better in on the yen that's
yeah.
there.
Yeah. So this year's gains are driven more by what's happening on the political front, right? So the new prime minister restructuring going on. There's inflation now. For years, Japan had deflation. Now it's got inflation, which is actually a positive thing for Japan because unlike in the UK, it's seen negatively. In Japan, it's seen as long as it's mild inflation, it's seen to
Well, they've
be a
needed it
positive.
for about 20 years, haven't they?
They've need,
Yeah.
yeah. And they've needed it. And because they had deflation, what happened was the consumers, they just saw prices keep going down. So they would put off their buying, right? They would put off buying any discretionary items. So if there's inflation now, they might, start buying again because they're notoriously high savers. So there's a whole sort of that consumer angle is kicking in as well. Yeah, so that's what's driving it. It's the prospect for restructuring and the economy. And there's the Japanese budget is happening, I think it's March next year. So that's going to be the next big catalyst because this prime minister is seen as very kind of pro fiscal spending and she's pro defense spending as well. And she's also got a warm relationship with Trump. And so politically, she's doing some good things there. And we've seen in Europe what's happened when Europe starts spending more in defense.
Mm.
The European economy is benefiting from that. So the same could be there for Japan.
No, it's yeah, I mean it's interesting. I think what about these some of like the investments here, some of these companies and the tr what do we call them? The trusts that you can invest in there in Japan. Am I making any sense?
Uh,
The unit
it-
trusts that come up that then kind of because you mentioned like every companies are owned by the employees and all that kind of
mm.
stuff. Like, do you just want to explain how that works and what you're thinking might happen if that's all restructured?
Yeah. So when you go and sort of have a meeting with a Japanese corporate, they look at shareholders as like an annoyance, right? So they think, what do they want, right? These Western shareholders, where it's almost like these companies are run as socialist enterprises
Yeah.
for their own employees. So they employ too many people, they have too much cash sitting around, they're not run efficiently. So if that changes and some of these policies are designed for that to change, then all of a sudden their ROE, their return on equity, is going to double, or potentially go up from very low levels. So that just increases valuation. So that's the sort of prospect. That's what people are holding out for because they've got their ROEs are like half of what you see in the US. And their profit margins are half as well because they employ too many people, right? And all of these things. So there's lots and lots of these things which there's low hanging fruit. Hopefully that but the problem is Japan is very slow moving, right? So the management they don't do things in a rush unless they're forced to. So that's the thing. It's a perennial disappointment because historically they say the right things but they don't do it. But can we execute now? That's the key thing.
Didn't they
They
call it
need
like the
a shot
widow?
in the arm, though, don't they, Manish? They need a shot in the arm because they've got much bigger demographic problems than the UK has got, for
Mm.
example. And
They've
a lot,
got
and they're not keen on net migration, generally
no.
speaking. So but they haven't done too badly over the last few years, bearing in mind all those constraints. And like you say, they're the one place where the COVID inflation wave has actually really played into their hands quite a bit.
Mm.
How about the fact that Trump is clearly pursuing a weaker currency strategy? Does
Mm.
that factor into causing any problems for Japan, or
It's been all right this year so far. The yen's actually weakened, so it's been okay for them. That's not been such an issue. Here's one risk which people will always point to in Japan. So Japan's debt is huge. It's the largest debt in the world. It's like 200% of GDP. So that's one concern that people always point to. It's high debt to GDP levels. In the UK, we're at about 100%. In Japan, it's 200%, over 200%. So that's one big concern that people have.
Yeah, I mean, I've got some investment in a similar ETF that's done well. I don't have strong feelings either way. I can kind of see how there's some decent upside here. I guess the only real downside is what you've mentioned about them being quite slow moving, and also if the yen then was to go up in value. Um, but yeah, it does seem like you're starting from a low base in terms of kind of efficiency and productivity in some of these companies. So it does sound positive. Yeah, all sounds good to me. Adam, what do you reckon?
yeah, I think it's definitely worth a punt. I think the continuity candidate bit that Manish was talking about, and Arbonomics was pretty well received, generally speaking. And there's been some movement on the yields that have really attracted a lot of attention, and Japan hasn't done too badly on the back of all of that. So, like I say, it puts them in a much stronger structural position if this pandemic inflation premium kind of hangs around for a few decades, which I've been a big proponent that it will, because it always kind of does, apart from anything else after a pandemic. So I think you're playing into a potentially winning game here. The currency risk thing, I just don't know enough, and would be wanting to probably hedge a little of that away. So would you do that, Manish? Could you do that if you wanted to? Could you just invest
You
in?
you can. I'm sure that there are ETFs that hedge out the currency. I
Yeah.
personally wouldn't do that because
Okay.
I don't have only because I don't have a strong view on the currency. It could go down. But I think one other thing which is related to the debt level, bond yields are going up. They were like sort of 1% not long ago, and they're up to 2% on the 10-year bond yield. So,
Yeah.
they're approaching levels which are concerning. Potentially if they keep going there. So, you want to keep an eye on bond yields.
It's the old trend is your friend, but not at the end, right? That's the thing. That's the
Yeah, I
thing.
like that. Yeah, yeah, totally. Yeah. That's exactly what it is. Yeah. So keep an eye on the bond yields.
Brilliant. Okay, well, I think we're done there for another quarter. But excited to see what some of the results are by the next one and how we've got on. But yeah, thanks very much, guys, and looking forward to seeing how this all pans out.
See you in 2026, unbelievably, he says.
Definitely.
See you next year. Yeah.
Cheers, guys.
Thanks.
Thanks a
Good
lot.
festive
Thanks,
period.
both.
I'll see you guys.
Bye.